All right, so we have a position on now in Micron, and we've talked about Micron the last couple days, that with earnings coming out next week on the 20th, and vol already being high, but going into earnings, as we typically see, we see vol trending higher. Why wouldn't we just buy premium, buy volatility now if it's going to go up, if we know it's going to go up by next week? And like I said yesterday, I am willing to put out on the line that this at the money volatility next week, okay, before the earnings event, what we're seeing now at roughly 70% or so, which is, obviously extremely high. My guesstimate is that we're going to see 100 plus implied vol, like I overrode in the system here. And so if that's the case, if we expect volatility to go up by, let's say, 30 points between now and next week, why wouldn't we buy it, right? So what is the measure? What is the measure for implied volatility? And how does that affect the price of an option? Okay, what is the measure? What's the Greek measurement, guys? Yes, great. Vega, exactly. Okay, and you can see we have Vega of each option listed here. So unlike delta, which represents how much the price of an option will change when the stock moves $1, Vega represents how much the price of an option will change when implied volatility moves 1 point. Okay, so let's get this up on the board here. And I'm going to label this Micron Vega Theta comparison. And let's put some notes on here. Earnings are 920, and we are pretty certain that IV will be higher before earnings. Okay, so current at the money IV is 70%. I'm predicting that it will be 100% or higher before earnings. Okay, so the question is, why wouldn't we buy the IV now if it's going up? Okay, so well, Lionel, that's what I'm saying right now. If we know it's going up, though, okay, it is really high right now. But if we think it's going up even further, why wouldn't we just buy it? Okay, and going back to our screen here, okay, right here, so next week's at the money option, which is the 43.5 strike, stock's trading, 43.50-ish, is trading 70 implied vol. Okay, everybody see that? Okay, and the theoretical value of the 43.5 call, $2.08. Okay, so let's get this on the board. So the SEP 21st 43.5 call with the stock trading 43.75 is 207 at a 70% implied vol and a Vega of 2.88, which I'm going to show you in a second. Okay, you can see right here, the Vega component to that option is 2.88, meaning for every 1% the implied volatility changes, the value of this option is going to change by almost 3 cents. Okay, that's 2.88 cents. Okay, so if I'm predicting that this implied vol is going to increase to 100, what should happen theoretically to the price of this option? Okay, Ning, yep, it should increase. Christopher, you just gave me an amount. How did you come up with that amount, Christopher? Okay, John, you say it's going up by 60 cents. Okay, so what Christopher just did is he took the increase in the implied vol. Okay, good one, Robert. Yeah, except we're using a different strike today because the stock was lower, but that's good. He took the increase in implied vol up 30 points, multiplied it by the Vega. So watch what happens, guys. I'm going to override the theoretical value by inputting a 100% implied vol here. Watch what happens right here. Watch what happens to the value of that option. Boom. It increased by 85 cents. Aw, Christopher, that's so nice of you. Now, Christopher, all you have to say is the Cubs are going to win tonight, and we're all good to go. Okay, so if we know, or we feel, or I feel, that this implied vol is going to increase to this 100-ish range, why wouldn't we just buy implied vol right now, even though it is so incredibly high? Okay, so if we increase the IV to 100%, the Theo value increased to 293. Okay, thus the 86 cents that Christopher had mentioned, which was just a calculation of taking the Vega 2.88, multiplying by the increase in implied volatility, and that equals 86.4. So the value of that option would theoretically increase by 86 cents. Okay, everybody with me so far? So again, the question is, folks, why wouldn't we just buy volatility if it's going up? If that implied vol is going to be 100 or somewhere thereabouts next Wednesday, which is the day before earnings, why not buy it? Well, the answer, let me put the question here first. Why not buy it now if the IV is going up? Well, what happens between now and next Wednesday? Regardless of whether the stock goes up, down, stays the same, what's going to happen between now and next Wednesday? Bingo, Alice. And thank you for joining in. There we go, everybody. Perfect. We have to factor in the theta decay. So how much is that theta decay? Well, the easy thing to look at right now is the 43.5 call option is basically all premium right now, with the exception of 10 cents at this point, because the stock is now 43.60. So if it's trading 209 and there's 10 cents of intrinsic value, then the remainder, or $1.99, is the premium, the extrinsic value. All of that $1.99, every last penny of it, is going to go to zero from a premium standpoint by next Friday. So not next Wednesday, the day before expiration, but by next Friday. Okay, so this option, and we can do this handy-dandy calculation here. Okay, if we look at this right here, let me take off all these colors so we don't get confused. Okay, this is a graph just of this long call, right? Stock goes up, we make money. Stock goes down, we lose money. But right now, it's showing a decay. You guys should not be on the whiteboard. Jake, anybody else besides Jake on the whiteboard? Jake, just refresh. You should see this graph. Okay, so as you can see here, right now, there's 10 cents of theta, 10 cents of decay a day. And as we just calculated, and I'm going to go to the whiteboard now for a second, or actually I had just written it on the screen, we said there was $1.99 of premium, right? Well, if we look right here, premium over parity, $1.98, okay, rounding difference. Okay, so what we can do on this graph is look ahead to next Wednesday, the 19th, and look how much the value of this option just changed. Okay, so today, here's our P&L. Okay, we're right at zero, or positive 6 cents. If I move the day ahead, and this takes into consideration now the next 8 days, the value of that option dropped by 97 cents. So going back to our calculation, if we said that the increase in implied volatility was going to make the theoretical value of the option increase by roughly 86 cents, that is going to get offset by the amount of premium, the amount of theta decay between now and next Wednesday. So the amount of theta between now and next Wednesday is 97 cents. And that's why you can't just buy volatility a week out, 3 days out, 12 days out, whatever it is, without taking into consideration what the time to expiration or the amount of time passing is going to do to the price of that option. Right, Alan. So in reality, if we just waited between now and next Wednesday and vol increased from here to 100%, we would actually lose 11 cents to that option. Exactly correct. Okay, so it's imperative that you really understand the Greeks and how they kind of work together. The big ones for us, obviously delta, right? We always talk about delta, but then Vega and theta as well. Okay, did that help? Because I know yesterday there was some question about why not just buy the volatility now if it's going up? So I want to make sure that everyone is clear with that. Thank you, Shabte. Your head is swimming, Thomas? Yeah, it should be. It should be. Okay, you're not going to be able to pick up everything at once. But don't be afraid to ask questions. Don't be afraid to have me repeat things. And most importantly, the reason why we record these talks that we have is so at 8:30 tonight, when you're bored, not doing anything, or if you're like me and you wake up at 3 in the morning, you have something to do rather than turning on Netflix and looking at watching the next episode of Ozark. You can listen to me. By the way, I'm now on episode number 6 in season 2 of Ozark, and it is just getting darker and darker. What a great show. No, Ning, it just happens to work out mathematically in this instance. No. Because we don't know for certain that implied vol is going to 100. Maybe it's going to 98. Maybe it's going to 120. I'm actually saying it's going to go higher than 100. The rate hike, no. That's factored in. This is going to be a dud of an announcement for the rate hike. It's factored in. They're not going to change their stance, their outlook for what they're going to do in December. They're still going to say the inflation is humming along. We're going to try and keep inflation in check. We're going to moderate, wage growth, unemployment, and after they raise rates, it's still going to be a 60 to 70% probability that they raise rates again in December. Take that to the bank. All right, guys, let me get this video populated, and I will be right back and post it up in the room. Thank you for your time and your patience.